You know, for most of us, March Madness starts this week. But for those in the real estate industry, March Madness started on March 1st. Actually, the day after the US and Israel basically annihilated the Iranian leadership and started attacking Iran. It has been a crazy, crazy month so far. This week has been no different. And we're going to get into that and more today on the Housing Market Update. Let's start with the big three. Prices are steady, no real change there. Inventory is up in certain parts of the island, and rates are up too. What are the headlines this week? Well, here's the biggest headline right now. VA webinar. That's right, online, we are doing a VA home loan webinar to educate you, your clients, your friends, your family, anyone who's a veteran or works with veterans on the VA home loan benefit. That is this Saturday, 10 a.m. Hawaii Standard Time, so 4 p.m. on the East Coast. Sign up. You got the QR code. It's right here. And man, I'd love to see you there. We're going to talk about everything VA loan related, from 1, affordability, 2, the current market, 3, the actual product. How does a VA loan work? We're going to talk about building a legacy and how I'm helping veterans buy homes with affordable mortgage payments right now. And then we're going to talk about what's the process for buying a home. All right, where do I start? I just talked to a young 21-year-old yesterday. It's freaking awesome. And he asked me, he said, I want to buy a home, Larry. I don't know where to start. And I'm like, dude, you're starting the right place. You're talking to a loan officer. Let's get you pre-approved. And then the education starts from there. So please sign up via the link. Love to have you there. Now for the rest of the news. Let's go to the Middle East. That's where all the action is. And this week, mortgage rates hit a 7-month high. Actually, they really haven't been this high since November of 2024 was the last time they were really this high. That's not bad, but still, how we started the year with interest rates coming down, and we'll go through that later, and they've gone up. And that spring rally that we were seeing in the housing market, and truly we have seen a really robust housing market to start the year, man, it just got body checked. All right, and we're going to see what the impact is going to be when we start getting the April reports and the May reports, because really the people who are closing in April and May are people who would be buying in March and early April. Here's the other thing. We got this oil shock. All right, the oil shock equals an inflation shock, which equals higher rates. They're all related. And oil, Brent crude, has gone over $119 up to $120 a barrel. And we just yesterday, or actually I guess it was Wednesday, we attacked liquid natural gas resources in Iran. Well, they came back and said, hold my beer. They hit Qatar's, the largest liquid natural gas fields in the world, and they hit them. So that sent oil prices up on Thursday. You also got the continued risk in the Strait of Hormuz. There's no transiting right now, or very little transiting through the Strait of Hormuz. It's really the nuclear button for interest rates. And you know what? How do we ensure secure passage of shipping through the Strait of Hormuz? The U.S. can't do it alone. We don't have the small craft available, or the small craft that make transiting safe for shipping. We control the air and we control the sea, but you know what? It doesn't take much. It takes one small boat, one unmanned vehicle, one shoulder-launched weapon to take out an oil tanker going through the strait. And NATO's not going to help us. We don't know. U.S. can't do this alone. We got $2 billion warships. We don't got $200,000 or $100,000 or even $5,000 boats, fast boats. So again, U.S. can't do it alone. We got to figure out how we can ensure safe passage of shipping through the Strait of Hormuz. Until we do that, until we have safe, effective, and permanent shipping going through the strait, fuel prices are going to remain elevated, and we're going to see continued volatility in the market. All right, so let's continue. What is the impact of the Strait of Hormuz? Well, Treasury yields are climbing. The bond market is pushing interest rates higher. It's not the Fed, by the way. It's the bond market. It's reacting as people flee from the stocks into safety that Treasuries and mortgage-backed securities yield. Here's the other thing that happened this week. The Fed stayed put. All right, the Fed has been seesawing back and forth. Beginning of the year, their biggest concern really was employment. Employment numbers have been bad. Inflation has been steady. Well, guess what? inflation's starting to go up. And now that's what their concern is. Matter of fact, Fed Chair Powell has basically said, hey, we may not lower the Fed funds rate until April of 2027. So that was that's like a fart in church. That just didn't go over very well. So what's the bottom line? Well, rates aren't rising randomly. All right, they're reacting to the global energy risk. That is quite frankly driving everything. And the Fed is not the story here. It's oil plus inflation plus the bond market. The three of those mixed together, it's a bad drink, and we're having to drink it right now. And the biggest risk is if oil prices spike again. We've been pretty lucky as far as oil prices relating to mortgage rates going up. Yeah, they've gone up, but they could go up a lot more, and they haven't yet. So here we go with the big reports that came out for the week. Home builder sentiment, the National Association of Home Builders Sentiment Index came out, and you know what? It's better than it was, but still kind of sucks. You're talking bull or bear. We're still in bear territory. Kind of feeling, just kind of meh. Just not positive, but more positive than we were last month. And really the most positive we've been since December, but negative overall. All three metrics, current sales expectations, future sales expectations, and buyer traffic went up. But hey, it's hard to get excited about a 25 on buyer traffic when you really want to be above 50. But still, hey, any positive movement is positive movement, and we like that. And this is despite this sentiment staying low. It's despite interest rates really being almost a quarter point lower than they were at points last year. So what's really impacting the home builder sentiment? It's not so much the interest rates. It is the interest rates, but it's the affordability. And it is also the construction costs and the labor costs. Those costs have not really gone down for builders, and they're feeling the pinch. They don't want to overbuild, and now they got a bunch of inventory sitting on the market. So really, this home builder sentiment report, good, not great, but better than it was before. Pending home sales. Pending home sales actually saw a nice rebound from the report in January. We had a 1.8% month-over-month increase in the month of February, which is better than expectations, but still, we're at a historically low pace of sales at 4.09 million. We need 4.5 to 5 million for us to really be in a good position as far as supply demand. We're just not there. I would say also the other thing that's impacting pending home sales, because this report here basically is telling us what our March existing home sales is going to be. Hey, everyone's impacted by weather. We've had some wicked bad weather on the Northeast. Get it? Wicked bad weather? Anyway. And then we've had some pretty gnarly weather in Hawaii this last couple of weeks as well. So the weather's going to have some impact. Nobody's going and looking at houses when they got no electricity in them houses. And that's what we actually had last week in Hawaii. Overall, a good pending home sales report. Not great, but good, and showing some progress. But again, this is for February. This was before March Madness began on March 1st. Thinking about selling your home in 2026? The truth is, timing the market isn't about guessing. It's about reading the signs. Many homeowners either sell too early and leave money on the table, or wait too long and miss their window entirely. And hey, I'm one of those people who did. My biggest regret in real estate was selling my home in Virginia Beach in 2019. If I would have held that home, instead of losing $2,000 on the sale, which is what I did, I could have made $100,000 to $200,000 if I would have held on to it. But you know what? I thought I had to sell, and I didn't. And I was tired of being a landlord. But the biggest mistake I made was not timing the market. Hey, if you're a homeowner, this isn't just a transaction, it's a major financial decision. And uncertainty around rates, prices, and demand can make it hard to know when to act. Here are some key signs that now might be the right time to sell. Buyer demand is still strong in your area. Low inventory combined with steady demand can create favorable conditions for sellers. Home prices have stabilized or peaked locally. Real estate is hyperlocal. If appreciation has slowed in your neighborhood, that could signal a shift. Interest rates are fluctuating. When rates move, buyer urgency can increase, especially when buyers are trying to lock in before rates rise further. If your home equity has grown significantly, if you built substantial equity, selling could unlock opportunities for your next move or investment. And inventory is starting to rise. More listings can mean more competitions. Selling before inventory builds further can help maximize your position. Your personal goals have changed. Sometimes the best reason to sell isn't the market, it's your life. Family needs, relocation, or financial goals can outweigh timing. When mortgage rates shift, buyer affordability changes. That can directly impact how quickly homes sell and at what price. That's why timing isn't just about price, it's about positioning. There's no such thing as a perfect market, only a smart decision based on your current situation and current conditions. If you're wondering whether now is the right time to sell, let's look at your specific situation and local market. Drop a comment with sell or reach out for a personalized strategy. And then we get the new home sales report. It's not a very good one. Matter of fact, we saw an 18% or near 18% month over month decrease in new home sales and an 11.3% drop year over year. Prices are down about 4.5% month over month to 401,000. But that's still, I think the last time I reported on new home sales, we were at like 375 or 395,000. So we are at 395,000. So really still not bad, pretty steady overall. And we have 9.7 months of supply. That's a lot. And new homes are sitting longer. That's basically what that is telling us. 476,000 homes for sale. That's pretty stable for the year. But we need 1 million. We need near 1 million homes for sale, really, for us to start seeing, I'd say, some more improvement. And here's another thing. The media is really attacking this new home sales report that, oh my God, the housing market's crashing. Well, if you look at the new home sales for November and December, you will see that those numbers were pretty high, like 701, 716. And that number is really the builders, which are publicly traded companies, pushing the product, giving all sorts of incentives to get buyers to buy, to pad their numbers for when they started reporting their Q4 earnings in the first quarter and then in the second quarter. So it's pretty natural to see a drop, although this drop is the lowest that we have had. This number was at 587,000. That's the lowest number of new home sales that we have had in over a year. So not a great number, not a good number, kind of a meh, bad number, but in totality, really not that bad. If this number continues to stay in the 500s, then we got some issues with the new home sales market. But for right now, it's a one-off. We'll see what happens the next couple months. FAQ Friday. All right. One of the things, it's not really a question so much that I get, but the discussion that I'm having with clients right now, fixed rate versus an adjustable rate mortgage. Now, when you say adjustable rate mortgage to people my age who are buying their first homes in like 2005 time frame, man, we have some bad. That's bad. That's like that alcohol that you can't smell because it messed you up. People don't even want to hear about adjustable rate mortgages. But adjustable rate mortgages that we're seeing now, they're not as dangerous as those ones that we had back then. I know I survived one of those adjustable rate mortgages. But right now, we have 5-year and 7-year adjustable rate mortgages, and I've been using those, I would say probably half and half with my clients. Maybe a little more than half of my clients are doing adjustable rate mortgages. And when you say adjustable rate, we're talking 5 years fixed. 5 years is a fixed, that mitigates a lot of the risk. And then there's no balloon payment at the end. The rate will adjust 1% up or down, depending on where the market is, up to 1% up or down every year thereafter. But really, the thought is you're probably going to refinance before that 5 years is up. And a lot of people ask, well, can I refinance out of an ARM? You absolutely can. And the goal is to refinance you out of an ARM into a fixed rate mortgage. But the difference right now between fixed rate mortgages and adjustable rate mortgages is between 3/4 of a point and 1/2 point. I have people in adjustable rate mortgages at 4.25 right now. They're taking seller credits and they're applying it to lower their rate. 4.25 right now for 5 years. That's pretty darn good, especially considering most people sell their home within 4 to 6 years of owning it. So the risk is mitigated, and adjustable rate mortgages may not be for everyone, but for many people, and most people, I would say, the adjustable rate mortgage is a great tool towards affordability. And if you don't know whether or not you should use one, give me a call. Let's talk about the numbers, because hey, I'm not going to tell you to use it if you're not comfortable using it, but I'm going to give you those options, and we're going to discuss the pros and cons of using a fixed rate versus an adjustable rate. And I look at the 5-year adjustable rate mortgage as a 5-year fixed rate mortgage, because that's what it is, with the adjustability after year 6. All right, let's get into VA rates. All right, we had the World Baseball Classic, and what is that? 1, 2, 3 strikes, you're out. USA put up a valiant effort again, and Venezuela. Hats off to them for winning the World Baseball Classic. Man, that was pretty exciting to watch. You know what? VA rates or interest rate mortgage rates this week, it was 3 strikes and you're out, baby. First off, we had the PPI, the Producer Price Index report. That's wholesale inflation. It came in way above expectations. And here's the problem with that. That report, it's read from that report goes into the PCE, which is the Personal Consumption Expenditure Report, which is the Fed's favorite measure of inflation. So in April, when that report goes out, the expectation now is that inflation's going up. No bueno. So that was strike 1. Strike 2 is the oil price surge that we saw this week, multiple times, did not help us at all. And then the third, the Fed didn't raise rates. There was no real expectation. That wasn't a surprise. But the expectation that we were going to have a rate cut in April, well, that's pretty much off the table. I think it's down to 5% chance that there'll be a rate cut in April of 2026. The expectations now really are next cut's going to be April of 2027. That's right. Not 2026, but 2027. So those are like 3 Mike Tyson body shots, man. They're hurting. And it's knocked the wind really out of the real estate market right now, the mortgage industry, and certainly interest rates. But again, what goes up comes down. We just don't know when. That's the big question is, can we withstand these body punches and come back, see interest rates come down over the course of the next couple weeks?